Real estate beats stock market any day. In my opinion, for a young person, the biggest bang for your buck is go buy a duplex, triplex, or fourplex. I don't know any better financial investment to get a young person started.
In 2025, if you were doing a retail investment, help me understand the retail real estate investing space nationwide.
So,
Joseph Goslin, a commercial real estate investor, operator, and broker based in Dallas-Fort Worth.
Joseph has worked with investors, property owners, and business operators to help them make clearer, more informed real estate decisions.
when I buy a residential property, the condition of the property is the most important thing. In a commercial, the most important thing is the lease, not the condition of the property.
We're also talking about leases. Help us understand how you optimize these leases to maximize cash flow and ultimately to build generational wealth.
Yeah, so
Joseph, welcome to the episode.
well, thank you for having me. I appreciate it.
No, it's a pleasure. So Joseph, before we get into like the nitty-gritty, the technicals, I wanted to start with something that I think is generally overlooked. I wanted to really unpack mindset. I wanted to understand, how did you discover that first retail real estate project, and how did you conclude that this could be the path to financial freedom and not just, a career?
Yeah, so I got a little bit of a different background. I started as a software engineer, actually, and I've been in corporate America for many years. We used to invest in single family properties as our investment strategy. We started with rich dad poor dad like everybody else, right? And I have a love-hate relationship with that book. Uh, but in 2015, I found myself in a position where we had a few singles and a duplex and so on. And all of a sudden, I had one of them needed foundation work, the other one needed plumbing and AC and roof and all this kind of stuff. And I had to write about $45,000 of checks, basically, of maintenance repairs in 6 months period. And that was just unscalable, unsustainable. So the engineer in me kicked in and said, okay, there's got to be something better. And that's when I sat down and I looked at everything, all the different asset classes, and realized that I need to graduate to commercial. I need to take that step up to properties that reduces risk, make more sense, and have a little bit more zeros at the end of it in order to really build wealth. So that's how we got started in commercial. We actually got started in multifamily, like a lot of people. That was 2015, 2016. And we did the multifamily thing, and then at the end of 2022, we saw the writing on the wall and decided that multifamily is not going to be a good asset class going forward for a few years. It's a great asset class overall, just not in the next couple of years. So we sold everything we had with investors. We told our investors it's time to get out. And then we transitioned into the triple net world, the retail, a little bit of industrial, and so on. So
I love that,
we
Joseph.
moved into that.
I love it. Congratulations on your journey so far, and good luck as you continue to scale. I think for a lot of listeners, there's so much value there, and I just want to maybe slow it down and just unpack it a little bit. Joseph, what led you to think that, hey, I'm a software engineer? As a software engineer, I assume you were busy. I assume you didn't have that much free time, and I assume you were making a lot of money. Correct me if any of my assumptions are wrong. Joseph, are you married? Do you have any kids?
Yeah, I'm married with 2 kids.
So that's like another job right there. We love our spouses and we love our kids, but it is work. So you're very busy, and you're identifying some sort of gap that says, hey, I need to invest, whether that's in the stock market, through my 401k, or outside, and you alluded to single family real estate. So help us understand how you kind of made that first realization that a lot of people, don't make.
Yeah, well, I kind of mentioned it earlier, right? Rich Dad Poor Dad. That book changed my life. And I mentioned I have a love-hate relationship. I love that book because it got me and a lot of other people started in real estate. And it helps you change the mindset because I didn't want to stay an employee for my entire life. But at the same time, I think it's a little bit misleading because it's talking about cash flow, and everybody that talks about cash flow and single family in one sentence it's not there. It's wrong. It's a mirage. You'll have 100, 200, $300 a month cash flow, which is awesome. But then at the end of the year, a water heater goes out and just wipes away the entire year worth of cash flow. One fence goes down, that's 2 years worth of cash flow and so on. So in single family, that cash flow, if you don't siphon it away and put it aside as a reserve account, you're going to be in trouble. And a lot of people found themselves in trouble. So that's why I have a little bit of a love-hate relationship with that book. But I never believed in the stock market as an investment vehicle, mainly because I had no control. And I've worked as a software engineer. I worked for publicly traded companies. And I can tell you from a first-hand experience working for multiple publicly traded companies, any correlation between how the company was doing and the stock was random, like completely random. We could be doing great, signing on new customers, and one rumor would tank the stock. And the other way around, right? The stock was doing great, and I knew we had issues. So that's where I kind of lost faith in the stock market. And then if you compound that in the last 2 years, I think it was 2016, there was an SEC research that said about 60 to 70% of the transactions in the stock market are algo trading transactions. So it's kind of like, I'm a normal human being. By the time I put my button on the buy button, my finger on the buy button, those robots, those algo trades, I've already extracted 80% of the value. So that's why I kind of faced real estate, and I thought it made the most sense.
I love it. It was so powerful, and I appreciate you taking the time to kind of provide that depth of and that clarity of thought, because a lot of people mention Rich Dad Poor Dad, and it is a great book. But I think you eloquently stated something that I haven't really heard before. But I do firmly believe that there is an issue with cash flow in single family. What's the point of working hard to only make $100 a month? And you can look at your time weighted return, you can look at your IRR, you can look at it if it was like a full burr where you got all your money out. Fundamentally, it's still only $100 to maybe like $300 a month, depending on your single family house or door. One water heater, $1,200 bill plus, that's all your cash flow for the year. That's all your profit for the year. Yep. But I think to some degree, like once you drank the Kool-Aid, once you're like into real estate, you've read Rich Dad Poor Dad and you're gung-ho, you're excited and you're emotional. And it's hard to give somebody logic and break it down as you eloquently did in a way they can actually hear when they're just like, hey, I'm getting started, I'm doing single family real estate. So you mentioned the transition to multifamily. Was it multifamily in Texas or elsewhere?
Yeah, in Texas.
In Texas.
But I want to kind of put a guardrails a little bit about what we mentioned earlier. Real estate beats stock market any day of the just any day. So if I only have $20,000 to put down for a down payment on a house or do that, I'm probably going to go real estate over stock market. And in my opinion, for a young person, a young investor, the biggest bang for your buck is go buy a duplex, triplex, or fourplex with an FHA loan, move into one of the units, learn what it means to be a landlord, have somebody else pay for your lifestyle. I don't know any better financial investment to get a young person started.
I agree. I think also the leverage, the scalability of it. Tomorrow you can move out and have that third unit rented out in that triplex example. Those are all benefits, the tax efficiency. Those are all benefits that you don't get in the stock market. Typically your cash flow in your real estate is going to be much more than a dividend stock, depending on how you structure the deal and things of that nature. But yeah, I agree with you. So I want to understand, Joseph, these big bills kind of led you to research to conclude multifamily. And then you said something about you were analyzing the market, you were seeing the writing on the wall, and you transitioned out of multifamily. So help me understand that piece of your story, that piece of the journey.
Yeah, so I'm a very analytic person, right? Everything for me is numbers and data. I always tell our investors and my clients, like, we're investors. We make decisions in an Excel file. We don't make decisions in our gut. It's important to listen to your gut feeling, but the Excel better explain it. If the Excel doesn't work, the numbers don't work, we need to walk away. Don't get emotional over a deal. So in 2012 all the way up to 2022, almost anywhere in the country, we had a party. We just had a party. We had rents going up 5, 10, 20% year over year in some areas. And inflation was normal 2, 3%. So you had a positive gap between how fast your income grow versus how fast your expense grow. In 2020, we had COVID and inflation started running. In 2021, we started spending money like there's no tomorrow. And we got to the point where the Fed hit the brakes at the beginning of 2022. What we saw in 2022, we saw that rents almost everywhere in the country went flat. There was no more rent growth. In some areas of the market, we actually saw the rents go negative. But we, at the same time, since 2020, we saw inflation and cost of materials go crazy. And everybody's looking at CPI as an overall national level number. But let's put this in perspective. I don't buy cheese for my apartment building. I buy lumber and paint and sheetrock and rebar and concrete. And I also pay labor and I use vendors. And all of those, they went up 40, 50% in those 2 years. So we had expenses go crazy, go way, way faster. We had rents go flat, which created an inverse in those two graphs, to the point that now my expenses are growing at a faster pace, dramatically faster pace than my rent and my income. So with that negative difference between those two, you could have a beautiful Class A property, 100% occupied, functioning very efficiently, and you're still losing value year over year. I don't know who you talk to, but if they owned the property in 2023, they lost a ton of money in value just for insurance. We all got hit really bad with insurance increases. We're talking the lowest I've seen, it was like 30% increase, and I've seen people that their property insurance doubled in 2023. And that all comes out of your pocket. So if you had $5,000 more in your property insurance in 2023, at a 6 cap valuation, you lost over $80,000 value. And you had zero control. And you had zero way to mitigate that. So that's the kind of things that we saw coming up in 2022. That's why we knew it's time to get out. And that's what we did.
And do you feel like, Joseph, when you look at the market today versus the market in 2022, especially with respect to Texas, I assume you do Dallas-Fort Worth multifamily, correct?
We don't do multifamily anymore. But
in back in 2022. And at that point, did you see a lot of new construction coming up or not really?
Oh, yeah. There's new construction nonstop since 2012. It hasn't stopped. It still hasn't stopped. There's still more new construction going on. I think 2025 was the first year we actually saw a slowdown in new starts.
Okay. Which is interesting because you're talking about, hey, things are getting more expensive. Hey, expenses are rising. Income isn't rising. The profitability of these projects is dropping. The net operating income is getting lower. The real estate is worth less. And fundamentally, we're not looking at CPI. We're not looking at the consumer price index. We're looking at the cost of the goods that we actually use to build these apartment complexes. And the numbers don't make sense. So that's all very powerful. Like, makes sense for somebody else, or they think it makes sense for them. Good for them. I'm going to pivot. I'm going to move into a different space. So what did you move into, Joseph?
So we moved into triple net properties, triple net leases, NNN, right? We tell our clients, we spell triple net TTR, transfer the risk. So the way commercial leases are built, and this is a fundamental shift in understanding how landlord and renters relationship look like. In an apartment complex or single family, if the toilet is clogged, the landlord has to send somebody to fix it. If something breaks, the landlord has to take care of it. In commercial leases, what we normally see is if it's within your 4 walls inside the unit, I don't want to hear about it as the landlord. You have a clogged toilet, get a plumber. You have an outlet not working, get an electrician. It's your problem, your cost. Even if the AC breaks, they get their own AC technician. And if it's outside, then we can talk about who's responsible. It depends on the lease. Like, think about it this way: commercial real estate is got a lot of flavors, right? In retail, we can talk about your neighborhood retail, but we can also talk about a McDonald's. McDonald's doesn't want you to send a handyman to take care of anything. McDonald's doesn't want your roofer on the roof. McDonald's doesn't want to wait until you get an AC technician out. So a McDonald's would be an absolute triple net, is kind of like, don't get near the building. They don't even trust you to pay your own property taxes. They do it for you. And then in a retail center, for example, then the management company or the landlord, they will call somebody to fix a pothole in the parking lot, or if the exterior lights are broken, they'll send an electrician to fix it. So, but regardless, in both cases, the McDonald's and the shopping center, what the triple net lease says is that the tenant reimburses the landlords for those expenses. And the tenant reimburses the landlords for insurance, and the tenant reimburses the landlords for taxes. So, property taxes. So we basically shift all of that risk of insurance go up, property taxes go up, material go up, labor go up. We shift all of that risk on the tenant, and it's huge, right? It takes away a lot of the stress. It takes away a lot of the risk, and it makes your underwriting a lot easier. And what do I mean by easier underwriting? It's kind of like, if I'm underwriting multifamily property, I need to guess what rents are going to do in the next 5 years. And I promise you, in 2020, there was not a single analyst in this country that guessed that rents are going to go down in Austin, Texas by double digits. Well, guess what? In 2023, they dropped 12%. You have to guess what property taxes are doing. And while everybody's guessing they're going to go up, there's no control by how much, right? And then you have to also have to guess what your all the other expenses are going to do: insurance, taxes, maintenance, labor, all these things. You kind of guess it. And then the last thing you have to guess is exit cap rate. When you switch to the triple net world, well, I know what the rents are going to be in the next 3 to 5 years, because that's what the lease says. I have a lease for 3 to 5 years that says 3%, 4% increase every year, right? And I don't need to guess expenses, because honestly, I transfer it all to the tenant. So if it goes by 3%, 5%, 10%, it's not coming off of my valuation. So the only thing I have to estimate or guess is exit cap rate, and that's even game in both of those. Nobody has a crystal ball.
I love it, Joseph. I love how you broke it down. And I think if you're listening to this episode and if you're finding value, hit the follow button. This place is where we share real stories and real strategies every week that can help you on your journey to financial freedom, to passive income, to the future that you always knew you deserved. So, Joseph, I want to understand why retail in 2022 and not 2012? Because obviously you were making that transition from single family. You were looking at commercial real estate. At that point in time, why did you decide multifamily versus retail?
So there's a few factors to it. One, and I'll be honest and transparent here, I understood it better. I came from the world of residential, single family, duplex. Buying a 20-unit property was just more of the same. In my mind, right? It's not, but in my mind, it was more of the same. So it was easier to understand. It was easier to underwrite. The other thing is, I am not one of those brokers or one of those investors that have that tunnel vision and will tell you, oh, only multifamily. I only do multifamily. I don't care about anything else. Everything else is crap. I'm just going to do this. Right? You won't, even today, you won't hear me say only retail. That's the only thing. There's nothing better than retail. It's the ultimate thing. I believe in finding the right asset at the right time and understand where the market is. Because between 2012 and 2022, we had a party, like I said. Rents were growing insanely. And when you have a market that is zooming up, right, and growing so fast, the best value property you can get is the one with the shorter leases, because I can increase the value every year. If you had a McDonald's with a 10-year lease in 2012, you missed the entire party. So that's kind of like why we kind of transitioned more to multifamily, because we were right in the middle of, it was 2015, it was right in the middle of the party. We saw rents grow so fast year over year that we wanted to be in an asset class that doesn't lock us for 3 or 5 years. The other thing is that back then, annual increases weren't very popular. It used to be X% every 5 years. So, but now almost everybody are putting, at least us, we put in our contract annual increase, 3, 4, 5%, depends on the asset and the asset class. But we put annual increases into the thing to make sure that our properties don't stay behind.
No, very, very powerful, Joseph. I appreciate the natural progression you were sharing. And sometimes when you have these conversations, you discuss the idea, like, why would I invest my own money in this? Help us understand why this question is so powerful and how the listener can apply this before thinking about investing in any transaction.
So, here's why we said that. So we said that to our clients. As a broker, I tell it to my client, every advice you're going to get from me is going to be coming from that point. Am I going to put my own money in it? Unlike a lot of the brokers out there, I'm not a sales guy. I'm an investor first. I started as an investor and then ramped up my brokerage side of things. I didn't start as a sales guy that accidentally bought a property. So everything we do is from the perspective of an investor. We also have a commercial property management, and every decision we make as a property manager is also from the same perspective of, would I pay for it? How much would I pay for it? How am I going to get my money back? So I'll give, it's the easiest example to give. I don't have one plumber I call for everything. I have multiple plumbers. I got the handy guy that handles the small little things. I have um, the guy I use for most of the work. Is an experienced plumber, and he can handle a lot of things. But I also have the expensive plumbing company. I call them when I have a big job that I gotta make sure it's done right the first time. No do-overs, especially if I got a slab leak, right? Something that needs digging underground, breaking concrete. I'm not doing it twice. So that's an investor mentality. I'm looking at, should I spend that money? If I do, how do I make my money back? Is it going to make the property sticky? Is it going to make sure that my tenants are happy? Will it help me increase the rent in the renewals? It's always that mentality. So that's why when you work with any agent, any broker, and I really, it doesn't matter if it's residential, multifamily, retail, industrial, ask them, do you own the same kind of asset class you're buying? If you're buying residential, ask them if they invest in real estate. If you buy commercial, ask them if they own commercial assets. And if they don't, if it's a 25-year-old kid from Marcus and Millichap, which, no offense to the Marcus and Millichap, but if you're 25 years old and you've never owned a property and you never operated a property, the only advice you can is from things you learn through reading. So if you're gonna learn to swim, do you want to learn to swim from somebody that's been in the ocean or somebody that read about it?
No, I couldn't second that more. You always want someone with experience. You want someone who's been there. So help us understand, you've been there for a while. You've been in this space for almost 20 years now. So now during that period, you must have different like hacks or different processes. I know you've mentioned the Eureka Lease Navigator. Maybe help walk us through that and how that works and how that informs how you invest.
Yeah, so that's a good example of a system that we've developed over time. In residential, when I buy a residential property, whether it's a single family, a duplex, or even a 100-unit multifamily, the condition of the property is the most important thing. I want to check every outlet. I want to check every bathroom. I want to check every door cabinet. I want to check everything. In a commercial, the most important thing is the lease, not the condition of the property. Because if I'm buying a McDonald's, they don't want me to fix anything. They're in charge of the maintenance of the property, and it's McDonald's. I know they're going to take care of the property. But what the lease says is going to be different between, you'll find 7 different McDonald's with 7 different leases, because it depends on who was the buyer, who was the seller, who wrote the contract. It's a little game I tell my investors to always play. It's like the little fish, big fish. In every transaction, there's always a little fish and a big fish. We try to be the little fish in every transaction we make, because it's always easier to be the little fish. So if I can have if I own the building, but the tenant is a $600 million company, I'm the little fish and I'm happy. But when you're in a single family and the person in the property is obviously can't afford to buy a house, you're the big fish. So if there's going to be a lawsuit, it's always aimed at the big fish.
It's such an
So
interesting perspective because the other perspective is, hey, I want to be, the big fish because I don't want to get squeezed out of the transaction if the margins change or if there's compression or anything like that. So I'm very, very curious to kind of hear you elaborate more.
well, it's a risk mitigation. Honestly, I'm very risk adverse. I know that. So in retail, it's very common to see dark places. When you have a dark Chase or a dark Walgreens, it means the building doesn't operate as a Walgreens anymore, but they still pay rent. Walgreens is never going to default on a lease unless it's an absolute Chapter 11 bankruptcy for the entire network. They're not going to default on the lease and get involved in a lawsuit and get the reputation smeared over a small little lease. So they'll pay you the whole lease, even if they're not in the building. So because you're the little fish in this game, they're not going to take the risk of litigation or hurting their reputation as tenants. So that's kind of the perspective of little fish, big fish. I want the company that has more to lose to be my tenant than somebody that has less to lose than me.
Understood, understood. So I know we're also talking about leases. Help us understand, how you optimize these leases to maximize cash flow and ultimately to build, generational wealth.
Yeah, so a few things, right? So I'm still gonna go back to the earlier question about Lease Navigator for a second. So because every lease is gonna be different, I can come into a shopping center that one of our clients is buying and find 10 tenants with 10 different leases. And it's because maybe they were done by different owners. Sometimes a different broker will use a different form. Sometimes it's because one was written in 1994 and has been extended since then, and one was written last year and using brand new leases. So what we do is we go in and we have a 41-point checklist to look at every little thing in that lease. And the main categories that we're looking for is one is risk. Where is the landlord have exposure? The other one is where are all the terms of the lease in terms of financial stuff? Because we've found leases that had renewals, but the renewal was never recorded in the system that charges the invoices. So they just kept with the old lease 3 years into the renewal and didn't upgrade. Some of them will have annual increases. Again, if it didn't make it to the system, we won't be able um, to charge that. Fees, late fees, CAM charge reconciliation is a big thing, right? So CAM stands for Common Area Maintenance. That is one of the tenets of triple net, right? So we said NNN, it's property taxes, insurance, and common area maintenance is the third one. I've seen a lot of situations where the lease allows you, for example, to charge your property management fee. It allows you to charge an admin fee. It allows you to charge all kind of things, but they're never being charged. At the same time, I've also seen the other way around where landlords charge accidentally things they shouldn't be charging. And, when you deal with a national tenant, they can come back 3 years later and claw tens of thousands of dollars. And as a landlord, suddenly you're in a position of, well, yeah, I know I got that money from you, but now I have to write a $25,000 check because I accidentally did an accounting mistake 6 years ago. So again, we're looking at where can we generate more revenue Where is the money that is left on the table? Where are we bleeding money? And where's the risk and liability exposure? And that's how we round things up. Um, so that's that part of looking at an existing situation. The other thing that we're working on is when we write new leases, we try to make sure that we protect as much as possible, honestly, the side we represent. Sometimes we represent the landlord, sometimes we represent the tenant, but we try to protect the side that we represent to make sure that they get the most out of the lease.
Okay, that's beautiful. That's beautiful, Joseph. I really appreciate how you've broken it down, because ultimately, all of this does come down to ROI. We can look at the numbers, we can look at the pro forma, can look at the Excel, and ideally those numbers make us happy. But like you alluded to, it's not really about like the emotional response. It's about fundamentally understanding how much risk is involved. How do we mitigate risk to maximize return profile? So in 2025, if you were doing a retail investment, do you feel like Texas is the best place? Is it just the market you know the best? Help me understand the retail real estate investing space, nationwide.
So, I don't like talking about nationwide real estate in any concept. It doesn't matter if it's retail or not. The problem with that is retail kind of moves nationally, but it's so hyper local, it's insane. We've seen areas, even locally in Texas, we've seen areas that are, let's talk multifamily. That's the good example, right? Austin got hit really, really bad. We're talking double-digit drop in average rent, but Dallas didn't get hurt a lot, maybe 1% drop. Same state, two different markets, same asset class. So we're very hyper local. The other thing about real estate that I warn people about is real estate has invisible walls. So that means you can have the same property, same McDonald's. This one is on that side of the highway, this one is on the other side of the highway, and they're going to be dramatically different in valuation. So I, as a company, we're focused on Texas and some parts of Oklahoma, but it always markets that we understand. I won't try to sell you a property in Iowa because I don't know and understand that market well enough to feel comfortable to tell you, oh, that's a great investment, that's a great location. Now, retail is the one different asset class from all the other asset classes that you might be able to take a little bit more risk in picking out of state or out of market properties. And that's because you can bet that that Chipotle team already vetted that location. McDonald's doesn't randomly drop a pin on a map. They choose where they want to go and they do a lot of research about where they're going. So retail is gives you a little bit more, but not all asset classes, right? I wouldn't pick a random retail strip in Iowa because I have no way to know if it's good or not. But if I'm picking a national brand retail that I know how they vet their locations, I might feel more comfortable going out of state.
Definitely. And I think that's a powerful way to approach it. To really try to find the life hacks to see who's investing where, and then to try to understand why are they investing in this market, in this strategy, and is there enough meat on the bone, or does the risk parameters, the risk profile make sense for me? Joseph, you dropped a lot of wisdom. You shared a lot of value with the community. I appreciate it. We wanted to understand, if somebody's listening to this and they wanted to learn more, how can they get in touch with you?
Yeah, so they can either find me on LinkedIn. I'm an open networker, so if you send me a connection request, I'll accept it. Or go to our website. It's easy to find us. I'm sure you're going to put the link in the show notes. And we're happy to help.
Beautiful, beautiful. Again, Joseph, I think the power of today's conversation is that it proves that commercial real estate isn't just for institutions. It's really for anyone willing to learn how to buy like a pro and to learn by doing. In Joseph, in your experience, in your story, you're sharing that you went from being a software engineer to single family to retail, spaces. And I would say that when you talk to real estate investors, their journey sometimes is similar, where they go from maybe single family to multifamily, or multifamily to office, or office to storage. All of these different, commonalities and common themes, because it's really about understanding your market And I really liked when I asked Joseph about the market overall. The answer was what most real estate investors will tell you. I'm not going to answer the market overall because it's market specific. So once again, Joseph, thanks for taking the time to really help us understand how you optimize for investments, how you minimize risk, and how maybe we can apply that on our own journeys as we continue to scale. For our listeners, if you got value from today's episode, reach out to Joseph, connect with him on LinkedIn, subscribe to the channel, hit a like button, and share it with another friend who you think can benefit. It's episodes like this that really highlight how to build generational wealth and how it's built one brick at a time. I'm Mustafa Ladda, and this is MyFinJourney, signing off. Bye, guys.